Hello, chart watchers, and welcome to this Wednesday, September 12th, Market Watchers Live Show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, got an interesting day going on. The Dow Jones took off a little bit ago, but has since pulled back. Still, the Dow up 52 points today. The S&P 500 has moved into negative territory, down about 4.5 points. NASDAQ taking it on the chin after climbing back above the 20-day moving average yesterday. It's right back down beneath it today, down 62 points. The Russell 2000 at its lowest level in about 3 to 4 weeks, down 10 points, 1708. Remember, the breakout came at 1707, so it is challenging that support level once again. 10-year Treasury yield down about 2 basis points today, just under 2.96%. It's been on a big rise to the upside, so it remains in an uptrend, but it is down today. Volatility index is on the rise. Earlier had moved down below 13, but it has rebounded and is now up almost 3% on the day. Energy, leading sector today, performing pretty well, up nearly 1%. Consumer staples the same. You can see, though, the energy has bounced or has pulled back quite a bit from its earlier high. Boeing, big move up today. That's one of the leaders, if not the leader, on the Dow Jones. It is challenging 355 price resistance that it saw twice back in August. Hit that level, pulling back a bit, but still up $8 today. Chevron getting an upgrade. We'll talk about that a little bit later, but Chevron up almost $2 today and challenging some overhead resistance. Apple and Goldman Sachs, two of the weakest performers out there on the Dow. We got both down off of some strength, at least with Apple. Some nice strength yesterday off its 20-day moving average, pulling back again, still in a little bit of an uptrend. We'll see if it holds. Goldman Sachs, though, clearly has been in a downtrend for the past couple of weeks, and that weakness continues as we threaten the August low. Okay, speaking of threatening, Aaron, I am on the East Coast in the Carolinas, and I'm
feeling in the direct path, right?
I am feeling threatened right now.
I would too, with looking at the center coming right at me.
I feel like I have a bullseye on my back. I am just a little south of Charlotte, North Carolina, for those of you that don't know. Of course, I'm not on the coast. Charlotte is inland a couple hundred miles from the coastline, but still, this hurricane is packing a major punch. They're forecasting it could become the worst hurricane on record, at least north of the Georgia area. And they're saying the big problem, I think, that we've got here is that it looks like the hurricane could stall. And if it stalls, that just means we are going to be inundated. They're calling for up to maybe 40 inches of rain in some areas.
Oh, goodness. That's a flood.
I've never seen anything like that. I think we're going to have new rivers if we get hit with that. So,
are you heading anywhere, or are you going to stick it out?
No, we're far enough inland, and we shouldn't have. I mean, we're not. We don't have a problem in this area with flooding, although we also have never had rain. So
as long as you're not sitting on a floodplain, I think you may be okay.
Yeah, the problem is when you get this much rain, and it's probably best that it kind of comes in the way it's coming rather than going up through the Virginia and Maryland, D.C., Pennsylvania area, because they've had a record wet summer up in that area. So their ground is already saturated. If they had this storm coming up there, I think that could be really, really bad, very destructive. So, but with the kind of rain they're calling for, it's going to mean pretty saturated grounds here. And with high winds, we'll probably have trees, power lines, everything down, I would imagine.
Meanwhile, over here, I can count on two hands how many rainy days we've had this past year. It's been dry.
Well, we're going to have one or two, but they're probably going to be really big ones the next couple of
years.
Yeah. We'll see. But we do have a guest in. Brian Livingston is joining us today. So happy to have you here, Brian. I know you are sitting in the cooler temperatures in Seattle in our home office right now. How are you doing?
I'm good. It's 55 degrees F in beautiful downtown Redmond, Washington.
Wow. That's a far cry. What do you got over there, Aaron? Is 55 degrees? I'm going to say no.
No, it's 65 now, but it'll be 89 for my high. So
great. I was thinking you were going to tell me it was 89 going up to 110. So
no, we had 100-degree weather last weekend, but it looks like we'll be getting a reprieve. Maybe fall is actually going to arrive here. So and bring some rain. We could definitely use that. I'll take some of yours.
Well, I don't think it's going to come across the country. That's not normally the way the weather travels, but maybe you'll get some of your own coming off the Pacific at some point.
Yeah, here's
Yeah, I know we got a lot going. Brian, if you can stick around, we'll bring you back in about 15 minutes around 12:20 Eastern.
I'll be
look
here.
forward to your presentation. Okay, Aaron, why don't you take it away?
Yes, let's get started. All right, our upcoming schedule. What's coming up this week? Tomorrow we have Grace and Rose from the Seattle mothership, and Mary Ellen McGonigal is going to join us on Friday. If Tom is flooded, we'll have her co-host with me, so we could have a great show with two women hosting the show. And then on Tuesday of next week, I have a workshop. I haven't determined what I'm going to do. I had an idea, it escaped me, and I didn't write it down, so I'll take your suggestions. And then we have David Keller returning on Wednesday. I'm really excited to talk to him since ChartCon. Today's agenda, Brian Livingston, who we just introduced, he's going to take the beginning part of our show after the technical news. The 10 and 10 to 1, our first symbol is going to be Eritana Therapeutics, PetX. And then finally, we'll finish off with some spotlight stocks. We'll give you some, very interesting stocks that maybe are breaking out of bases or unusually high volume. You'll see. We have some great stocks to share with you. So let's go ahead and get it started. Tom, news and headlines. Let's go.
All right. Well, first, let's start off with the 10-year Treasury yield. This, as I mentioned earlier, is down about 1.5 basis points right now, but the clear uptrend in play in the short term. We look back over the last 2 or 3 months, we just remain confined in this range from about 2.81% to the downside, 3% to the upside. It is important, though, if we do break out of this range and get back up through 3%, it means money's rotating out of treasuries, and that could be the fuel to continue the push in equities to the upside. Something to watch out for. Now, if we fail here, though, and we start to see the yield moving back down in the short term, that means money is moving back into treasuries, and that could thwart the potential rally in equities. So something to keep in mind. As far as economic news, we had one report out this morning. We did get the August PPI, and it actually fell 0.1%. Market was expecting a rise of 0.2%. The core PPI did the exact same thing. Fell 0.1%. Market expecting a rise of 0.2%. So the wage inflation that we saw in non-farm payrolls last Friday is certainly not carrying over in the producer prices, as we're not seeing much inflation at all. In fact, August showing a little bit of deflation with that slight decrease. There are a couple of charts. I'll tell you what, this is the chart we were just talking about, and I was joking earlier with Aaron and Brian, but this is what we're looking at in South Carolina. If you look right in the middle of this circle, that's about where I am. So this is going to be an interesting week for sure. As far as some of the things taking place in the market, I pulled up the semiconductors stocks within the technology sector and looked at the percentage change over the last 3 months and check out what has been happening with a lot of these semiconductor stocks. When we get into the spotlight stocks, I'm actually going to focus on a number of these, so I won't spend a whole lot of time here, but just take a look at the carnage that is taking place. Many of these stocks down 20, 30, 40% in the last 3 months. You've got some big names in here too. Take a look. As I go down here, Micron. Look at Micron with a scooter rank now of 1.2. It's been down 32% in the last 3 months. Obviously, the market is forecasting some not so great things for this area of the market. NXP Semiconductor down 25%. Applied Materials, 25%. I mean, the list just goes on and on. Microchip Technology, 20%. Intel down here, 18%. Just continues across the board. So this is an area of the market that is somewhat, I don't know. I think when you think about performance on the NASDAQ, you think about semiconductors and leadership from semiconductors. We are not seeing that right now. And as I mentioned before, we'll take a quick look at the semiconductor chart. But as I mentioned earlier in my blogs and on the show here, the internet space is also under a lot of pressure. So here you've got the semiconductors, big drop the last 5 or 6 trading days. This is how quickly this index moves. We were over 3,550 to begin September. Today we hit 3,300. This is an incredibly volatile group. We'd love to see it break out. Didn't make it. And then, of course, the bears are hoping we'll break down. So far, intraday, it looked like we were going to, but we have rebounded off the earlier lows. So at least in the short term, things might be looking up a little bit here. The internet stocks, this is a pretty bearish looking head and shoulder top, and we got a breakdown. I'm going to stretch this out a little bit so you get a better feel for what the chart looks like. But here, off of this uptrend, you can see a left shoulder. The pullback puts in the left side of the neckline. Here's a head. Got that island cluster top. Came back down, put in a right side of the neckline, bounced. We got the right shoulder, and then we broke down. If there's one positive, and I'm not even going to say it's positive, that volume, I would have been much more concerned if volume had been heavier. It was heavy. Definitely picked up as we made the breakdown below the short-term neckline support, which was around 1720 or so. But this measures from 1950 down to 1720. This measures about 230 points, which would take us down under 1500, very close to that March-April low. So internet's going to be an area to watch very closely. To the upside now, we've got to get back through 1720. Also, the declining 20-day moving average is at 1725. So this is going to be a key area of this of the internet chart in order to try to get through. If we can't get through and we turn back down, especially taking out the low we just saw last week, this would be very bearish for the internets. So now you've got two major components of technology, the semiconductors and internet stocks, both with some issues on their charts that we want to keep watching. I mentioned in my blog this morning two key areas that held, or two key stocks that helped the market yesterday. Apple was one. Nice bullish engulfing candle at the 20-day moving average. We are pulling back today, so far holding on to this support area. And then the other was Amazon. Amazon pulling back, testing its 20-day moving average before posting or printing a bullish engulfing candle as well. Saw some earlier weakness in Amazon, but we have bounced back off of the earlier low. Amazon continues to power forward, one of the best performing stocks in the market, and so far looking pretty good. Last thing I want to mention, the XLF relative to the S&P. I put this chart in my blog this morning. Let's just take a look at a 1 year. Actually, I'm going to go back 2 years, and we'll make it a line chart, which I think is takes out a lot of the noise. But clearly you can see this downtrend. And so talked about the 10-year Treasury yield earlier, trying to get through 3%. Normally, when rates are moving higher, as they were from 2016 through early 2018, normally financials outperform. But notice as we started this uptrend here in September in the yield, maybe even the latter part of August, we're not seeing it in terms of outperformance by the financials. This is something I'd want to keep an eye on as well. Okay, Aaron, I know there was several upgrades and downgrades. What do you see there?
All right, let's get it going. All right, we did have 7 that I'm going to go over right now. Okay. Make sure I'm where I need to be. Okay, there we go. Sorry about that. All right, so we had 3 upgrades and there are 4 downgrades we're going to look at. I'm going to actually start with Snap, which had a downgrade today. And I find it interesting because if you recall, if you watched yesterday's program, we had a upgrade on it yesterday. And I had said, oh, I would never be even interested at all. And so I found it kind of funny that today we ended up with a downgrade, of course, by somebody else. BTIG Research moved it from a neutral to a sell. I see room for my PMO to go lower. We are below support for this past year, which is why I went ahead and did a weekly chart for you, stretched it out just a bit. And you can see we're making all-time lows as we continue to go along on Snap. Look at the weekly PMO, OBV volume. Everything is just, look at the red bars here on volume. I just don't see any opportunity at this point. The market definitely is having some issues with Snap. And so, yeah, not a surprise to see the downgrade because I was really surprised to see the upgrade yesterday. All right, other downgrades, Acuity Brands. Goldman moved this from a neutral to a sell. I found today that I could give a lecture on setting up support and resistance lines today, because so many of them have so many touches. In fact, I didn't even mark that one. So I thought it was interesting to go through that. But as you can see, we dropped below this area that had been resistance, and it's pushing up. You can see in the thumbnail, we're near the top of that OHLC bar. So it's trying very hard to get back above what was previous support yesterday. But look at the PMO, very overbought. It's heading down. We had a fake out earlier, but I would say I would be looking for the actual drop at this point. And with the downgrade, I'm sure that will encourage it to move much lower. Micron, you talked about that just briefly, I know, to start. Micron is certainly one of the big suffering stocks in the tech area in the NASDAQ, and it continues to just fall and fall. We have support down here, from these lows that we started back in actually October of last year. And that's where we're headed right now. We have a very oversold PMO. I mean, there's some opportunity here, but as you can see, the PMO on the positive side has gotten all the way up to a 10 and a 5, which tells me that the normal range for the PMO at best would bring us down to a -5, and we're not quite there yet either. So Micron suffering. It's now gotten the downgrade from Goldman from a buy to a neutral. I could certainly see it sitting at a sell, to be perfectly honest. All right, NXPI, this was downgraded from a neutral to a sell. And we can see that it had already busted down below the really important support, I would say, back here from May. And then we went down below that at the beginning of August, mid-August. And now, we managed to bounce off of that, but we came back down, broke through that support area, and are now breaking through that August support. Look at the PMO, top below the signal line, heading down for that sell signal, not looking too good for NXP Semiconductor. All right, that's it for the downgrades. Let's look at a few of these upgrades. Alcoa, I thought this one was really interesting. I said that this is critical support. I think it could offer some nice support. We could see a rally off of that. But because I see the 50 below the 200, it's in a bear market configuration to me. And so we shouldn't really expect bullish conclusions to what seems like should be a bullish conclusion. I would make a note that, you do have a double top here, but it is not textbook. We need to come up into a double top, not down into it, because those are not continuation patterns. They are reversal patterns. So don't get too wrapped around the fact we may have a double top. Get wrapped around the fact that 50 is now below that 200-day EMA. And if I move this very quickly to a, weekly chart, there we are. Look at how important that support level is. And it even comes back here to 2017 where it topped out. So really important support. I think there is a possibility it could certainly rally off of it. But again, looking at these EMAs, I'd be very, very careful. Chevron also upgraded today from a hold to a buy by HSBC. I'm liking this pattern we've got. We've got a declining wedge. They are bullish patterns. You're supposed to expect a breakout to the upside. 50 is above the 200-day EMA, so we can look for a bullish conclusion. Right now, we have a PMO that is getting ready to turn back up. So I see that as positive for Chevron. And I know that particular area of the market is also thriving. So I would very much be looking at Chevron right now. Tiffany & Company in what has been a strong retail group. Tiffany's been in a declining trend, though. And granted, we are bouncing off of it, maybe forming a little mini cup here. The PMO is starting to make a turn to, turn around. But I see this declining tops trend line and this trading, this channel here, this declining trend channel as a problem. I think there's a really good chance you're going to come up here, maybe spike out like we saw here. But I would be looking for a pullback. And again, maybe a cup and then a little handle could come down here. But we haven't gotten a close above the 20-day EMA in some time. And I'd really want to see that if I were to get into Tiffany. And that concludes our upgrades and downgrades, as well as our technical news and headlines. Time to bring back Brian Livingston. Again, welcome to the show. Really looking forward to your presentation. What do you got for us today?
Well, it's great to be here, Erin. And we have something that I think will help everyone who wants to invest in the market.
Oh, did we lose Brian?
Yeah.
I'm right here.
Oh, okay.
All right, there we go. Ta-da!
So if you're ready, we'll get started. Yeah, I know that people are sometimes with the market, sometimes they feel like they're fighting the market. And I don't think we need to feel that we're fighting the market. We want to move with the market, and that's what I'd like to talk with you about today. Shall we go?
Yep, go right ahead.
Something that we often realize is that computers, of course, are a huge part of investing these days. We used to do all of this with pen and paper. We used to do it with calculators. Now, if you don't have a computer, you don't have much to play with in the market at all. We are experiencing a great revolution, which is called FinTech for shorthand, or financial technology. This is something that goes beyond just having a laptop, something that goes beyond just having your own subscriptions to various computer services. If you were playing against the biggest chess grandmasters in the world, would you make guesses? No, you would use a supercomputer and you'd let the computer pick the moves for you. If you were on Jeopardy and you were trying to play the winners of Jeopardy, the champions, would you guess your answers or would you use a computer? Obviously, computers have excelled at both of these areas. They beat the biggest chess grandmasters and they beat the champions of Jeopardy. So now we are moving into a phase where people recognize that computers can do a better job than we can with our emotions. We see cats playing with red laser dots. And why do they do that? It's because the red laser dots move as though it were a bug or a mouse or something that they'd like to eat or chase. We need to realize that our own opinions make us move in the market the way that a cat chases a red laser dot. And of course, the cat will never catch the dot. It's just something that's an appealing kind of obsession. So when we allow our opinions to get in our way, we are fighting the market. We're not moving with the market. We're not letting the market tell us how we should be investing. And the truth is that academics, professors, Wall Street professionals have all studied what is it that really makes things go up and down in the market. And they know the answer. Now, I have brought out a book, Muscular Portfolios, and a website, muscularportfolios.com, which is revealing these secret formulas and giving it away for free. That's very important to me, that we don't charge anything for people to get these signals. We don't require you even to put in an email address. You don't have to register. You can get these signals absolutely free. Now, we want to look at how some of the greatest investors of our time have done what they've done. So everybody knows the name of Warren Buffett. Everyone knows that he is one of the most successful investors of our time. I'm putting a blinker on his performance. So from the beginning of the bull market, the bear market in 2000 to about mid-2015, he made 169% gain. That was more than double. It was triple or quadruple the gain of the S&P 500 between 2000 and 2015. So if we want to understand how we can be successful in the market too, we ask ourselves this question: how much did Warren Buffett outperform the S&P 500 during the last two bull markets? Was it A, more than 5 percentage points annualized? Was it B, 0 to 5? Was it C, he underperformed the S&P 500 during those time periods? Or D, we cannot determine it from the data available. And there's a poll that Stock Charts has been running to let people put in their answers. And we've seen scores of people responding to this poll, and you might be surprised by what the actual truth is. The truth is that Warren Buffett underperformed the S&P 500 during both of those bull markets. So if I put my blinker down here on the lower left, you can see that he actually went up during the bear market after the dot-com collapse in 2000 to 2002. If we look at the bear market of the global financial crisis, we can see that Warren Buffett lost only about 40% during that time when the S&P 500 adjusted for inflation went down 56%. So he has beaten the S&P 500 in both of these bear markets. But look here, in the 2002-2007 bull market, Buffett only went up 56% and the S&P went up 90%. In the current bear market, this chart shows from 2009 to 2015, Buffett went up 150%, but the S&P 500 gained more than 200%. Now, the secret here is that Warren Buffett has a diversified portfolio. And this is something that anyone can do with their IRA. They can do it with their 401k. They can do it with a taxable account. We are teaching people through the book and through the site that they don't have to beat the S&P 500 during a bull market. At times, the S&P will be the strongest asset class in the world. So trying to beat it during a bull market can mean that you're making yourself take too much risk. It may mean that your portfolio is not diversified well enough to survive a bear market. And let me tell you, after this bull market has been going for more than 9 years, we will see a bear market coming in the near future. What people don't seem to understand about the market is how much keeping your losses small makes a difference in your portfolio. So here we look at an imaginary portfolio. What if you could keep your losses down to half of what the S&P 500 has lost in bear markets, and then you only gained 2/3 as much as the S&P in bull markets? The answer is that you would almost double the gain of the S&P 500 over this same period, 2000 to 2015, that we just looked at Warren Buffett's performance. Look at this. The S&P 500 went up 82%, but if you could keep your losses to half of the S&P 500 in down months, and you could get at least 2/3 of the S&P 500 during up months, you would have almost doubled the gain of the S&P 500 during this 15-year period. It's a very well-known secret to Wall Street professionals, but it's very seldom shared with individual investors. This is something that people are constantly hearing: beat the market every month. And you can't beat the S&P 500 every month when it's really in a strong uptrend. It's something that just at random, the S&P 500 is going to be the best performing asset that you can buy out there. It's something that you want to beat over your lifetime. It's something that you want to beat over a complete bear bull market cycle. So if someone is showing you their track record of how much they've made in the market, and they're not showing you at least one complete bear market and one complete bull market, they're yanking your chain. They're giving you a period of time that's too short to really say whether that person had a lot of skill or that person had a lot of luck. One of the traits that we see in the market is that for the past 30 years, 40 years, the individual investor has been recommended to hold a lazy portfolio. This is where you have 5 or more asset classes. It's easy to put together a lazy portfolio since we've had mutual funds for decades. We've had exchange-traded funds for at least the last 30 years. That makes it easy for us to put together a diversified portfolio, but these lazy portfolios perform poorly. This screen shows the recommendation from Morningstar, which is called the Aggressive Bucket Portfolio. They have 10 different exchange-traded funds that they recommend you put your money in, and you just keep the same percentage of those funds at all times. The problem with that is that it underperforms the market, and it has losses that are almost as bad as the S&P 500 itself. So if we look at the lazy portfolio in the global financial crisis, look here, it lost 34%. Most individual investors would find that an intolerable loss. They would sell all their equities and they would be out of there. The S&P was down 51%, but you can't take these big losses. What we find in the book, Muscular Portfolios, is that by keeping losses small, by being diversified in low-cost index exchange-traded funds, but by checking your portfolio once a month and making gradual course corrections, letting the market tell us what's going up and letting the market tell us what's going down that we should stay out of, we see in this 43-year simulation, the S&P went up 10% annualized. The Mama Bear portfolio, which is a very simple 3 ETF portfolio, went up 14% annualized, and the Papa Bear portfolio, which is a little bit slightly more complex, went up 16% annualized. These are results that we want to see individual investors get market-like returns, but with bond-like volatility. And so these losses like 18% here and 21% here, those are tolerable losses. You keep your money in the market, you don't bail out. MuscularPortfolios.com updates tables like this every 10 minutes while the market is open. So you simply go, get the information absolutely free, pick a day of the month, the first trading day, the last trading day, the third day of the month, your birthday, whatever you can remember. Go to MuscularPortfolios.com and choose one of these portfolios. The Mama Bear portfolio is shown here. You just buy the 3 ETFs that are on the top of the list. The formulas have been shown that these are the 3 ETFs that are statistically the most likely to go up in the next 30 days. There's no registration required whatsoever. It's absolutely free. We have a newsletter that we'd like you to subscribe to, and that updates the book, and that's free, and we also accept donations. This is not something that I am a financial planner, I am a financial advisor, I am not. I am a journalist, and I want people to have this information absolutely free of charge. The book is on sale at Amazon.com right now. They're taking pre-orders. It is shipping out from Amazon, Barnes & Noble, and these are the places on September 25th. So if you get in line right now, you'll be one of the first people to have this information in your own hands. Questions?
Do you have anything in the room, Aaron?
All right. You know, somebody had asked about, are you familiar with John Bogle's thesis, and did you have an opinion on that?
Yes, indeed. Jack Bogle is one of 3 financial experts that we have modeled in the book. So we have Jack Bogle from Vanguard, we have Steve LeCompte, who's the CEO of CXO Advisory Group, and we have Mebane Faber, who is the author of the Ivy Portfolio, a very well-respected book about investing. We have cloned in the book Muscular Portfolios these 3 gentlemen's portfolios. So without any cost, without any registration even, you can follow exactly the 2 model portfolio that Jack Bogle recommends, 9 ETFs that Steve LeCompte uses as his universe, and 13 ETFs that Mebane Faber uses as his universe. This is absolutely free.
Excellent. Somebody did make a comment, and I suppose you might even expound on it a bit more. As you were talking, somebody said, this is why I think it is malpractice when financial advisors tell you to stay exposed all the time and then justify it with the statement, invest for the long run.
Yes, that's exactly right. Let me go back to the website. I believe that individual investors are misled by people telling them, just hold on, don't make any changes, don't adjust your portfolio to the market. People need to hear that if they just check once a month, this literally takes 10 minutes or 15 minutes at the most. We have some months when there's no change in Jack's portfolio, Steve LeCompte's portfolio, or Mebane Faber's portfolio. You look at the website, muscularportfolios.com, the same 3 ETFs that were rated the highest last month are the 3 ETFs that are rated highest this month. You look at the computer, you see that there's no change, you turn off the computer and you go out and have fun. That's really, really easy, and we think individuals are all capable of handling this much. If people want to be day traders, that's fine. If you have a successful formula, that's great. Most people have a job, they have a family, they have a life. They don't have time to be trading the market from 9:30 to 4 every day. They want something like this, an easy way for their IRAs to be invested, an easy way for their 401ks to be invested. The difference in your wealth at the end of your working life, if you have a muscular portfolio, it can be many, many times what you would have at the end of your working career if you stick with a lazy portfolio.
Okay, and then somebody was asking, how often do you rebalance the portfolios?
The muscular portfolios only need rebalancing if one of the ETFs is more than 20% off its ideal weight. So we've found that people who recommend you must rebalance if something is 5% off, that's wrong. You can wait until something has become 20% off its ideal weight. You are letting your winners run and you're cutting your losers short. That's a very big importance principle to anyone who is investing their money. With Jack Bogle's performance, he has only 2 ETFs that he is holding at all times, and that portfolio needs to be rebalanced only once a year.
All right. Right now, that's all I had in the chat room, but if I get some more, I will definitely interject. It would be nice, though, if we could get to your, just see the website a little bit.
Sure. What we can do is anyone can go to muscularportfolios.com. There's one page for the Mama Bear portfolio, there's one page for the Papa Bear portfolio, and there's one page for Jack Bogle's Baby Bear portfolio. So at that point, you can see exactly what we see on the screen right here. You can put in your email address and get the free email newsletter. That's perfectly up to people's preferences. We don't make any charges. We don't require any fees. And there's not even any need to put in your email address. But of course, you might benefit from the monthly email newsletter, which updates this and gives you the latest information.
Excellent.
Okay, I've got a couple questions for you, Brian, if you got a couple minutes, because, you know, this is not my style. I understand that it is the style of a lot of folks. You know, I do follow the markets pretty closely. And for me, diversification, while it may be safer to someone who's not watching the market, diversification is just cutting into my returns because I'm investing in areas of the market many times that are not performing very well on a relative basis. And so I've got some money in areas that's performing great and outperforming, but then I have other, you know, money in different areas that are underperforming. And so I guess it's just my own personal preference to avoid those areas. How much, like when you're looking at these different portfolios, how much does relative strength come into play? And in terms of modeling these different portfolios, I guess how much is relative strength considered?
Relative strength is very important. We've found three principles that individual investors' portfolios absolutely need to take advantage of. One is compounding. You let your money grow over time. The second is diversification. You don't expose yourself just to one single asset class like the S&P 500. And the third is momentum. It's been shown in hundreds of academic studies that asset classes which have gone up the most in the past 3 to 12 months have a statistical likelihood of going up in the next 30 days. That's really a very strong tendency for asset classes. It may not be for individual stocks. Individual stocks are very volatile and very unpredictable. Asset classes are much more stable. You can see that emerging markets are going down. You can see that the U.S. market is going up. And the same with other asset classes like fixed income, commodities, and precious metals. That's what we're trying to teach people. If you are a day trader and you like day trading and you're making profits, that's great. If you have an IRA, if you have a 401k, you may not be able to trade rapidly and you may not have an interest in it. For example, federal workers have the Federal Thrift Savings Plan, or the TSP. That program is great because the government puts in matches for you to earn more on your portfolio, but you're only allowed to trade once every 2 months. That would be impossible for someone to day trade, but something like Muscular Portfolios would help those people grow over time.
Okay, I mean, I just pulled up a chart here just to kind of illustrate my point. And, you know, granted, everyone's strategy is not going to be similar to mine. But when I look at the market, I take a look at the bull markets and the bear markets. And when you're going into a bull market, or while we're in a bull market, you can see the S&P 500 since bottoming back in 2009. I think everybody would agree that we've been in a bull market now for almost 10 years. And some of the things that I look for when I'm looking at the different areas of the market, for instance, I've got technology here relative to the S&P 500. And you can see that technology, for the most part, has been a steady outperformer in the S&P 500. You've got consumer discretionary, which went for about 2 years kind of sideways, kind of going along with the S&P 500. But you can see throughout the 10 years, it's been pretty consistently an outperformer. You've got industrials, which have been, again, an outperformer throughout the bull market with some periods of relative consolidation. And then financials, I mean, these are the four areas that I focus on the most. Financials have not been quite the same, but to be honest, what I expect out of financials is performance equal to the S&P 500. I'm not really looking, I don't view financials, especially banks and life insurance companies, I don't view those as particularly aggressive areas of the market, but you do want them to perform well to keep a bull market intact. And as I go down below, you'll see also that there are periods of strength in some of the defensive groups as well, like consumer staples and healthcare and utilities, these final three. But I find it personally better when the market is moving higher and you've got money rotating away from defense, like we've been seeing for the past couple of years, and into offense, like we've been seeing like I said, over these past 3 years. That to me suggests that you've got the market anticipating stronger economic growth. There's no real other reason why folks would be jumping in to these areas unless they expected that bottom lines were going to continue to increase pretty solidly. But these are the areas that I wanted to point out that have been performing pretty well. But then I wanted to bring up another chart, and I saw in one of the portfolios that you were listing there, the asset classes, gold was listed, and you can see that since 2011, gold relative to the S&P 500 has been moving down. So I'm not necessarily arguing with you, because I do believe that there are a lot of folks who really should be looking at some kind of a model that's more diversified, especially folks who are not watching the market on a regular basis. But when I look at a portfolio that's got gold in it, I'm just thinking all I'm doing is reducing the amount of money I should be making, because you've got a group, an asset class that has clearly been underperforming for a long time, and I continue to throw money at it. I just was wondering if you had any thoughts, or if relative strength comes in at some point to dictate how much goes into certain areas, or are there valuation principles that at some point come in and say, hey, you know what, this group is, from a value perspective, is just really looks really good, and as a result we're going to begin to start to overweight. How does that all, I don't know if I'm really being that clear, but
yes, of course.
How does the relative strength and all this relative performance of these various asset classes come into your thinking? How's that reflected?
The screen that we showed on the slide is months old. That's just from some point a year ago, maybe.
Okay.
As of today, in the Mama Bear portfolio, gold is rated 8th out of 9. So no one should have it because it's way at the bottom of the ranking in the menu. The Papa Bear portfolio, gold is ranked 12th out of 13. So it would not be in anybody's portfolio if they're checking the site once a month and they're upgrading to the top 3. The top 3 index funds are the ones that are the most likely to do well in the next 30 days. Gold is now nowhere near in the top 3.
Okay, that helped to clarify, because I saw those asset classes and I saw the gold there, and that one of the things I've been preaching, and of course everyone's got a different take on the market. Gold goes through periods where it does pretty well over a short period of time, but I think this chart certainly, or the chart that I had up there, certainly suggests that the gold hasn't been a very good place to be.
That's a very good question. Why are precious metals in the investing universe? Why are commodities in the investing universe? During the global financial crisis, gold went up. When the S&P 500 was down more than 50%, an investment in gold gained 9, 10, 11% during that period. And our formula was keeping people invested in commodities, investing in gold while they were going up, and not any longer. So treasuries went up, gold went up, commodities went up during the global financial crisis, and that's what asset rotation means, is you move your portfolio once a month into those assets that are in uptrends, and you keep your portfolio out of assets that are in downtrends. How do you know? The formulas are completely disclosed, so you can see exactly why the computer has rated certain things to be in the top and other things to be in the bottom. There's no black box, there's no secrets. Everything is right up front.
All right. I do have your website up. I had a couple more questions. One was stop loss systems exist for a reason. Why aren't they used on these portfolios?
You don't need a stop loss if you are rotating your portfolio once a month into the asset classes that are rated the highest. The New York Stock Exchange has prohibited stop loss orders. They do not protect people, and they do not get people out at the price they set. A stop loss order immediately converts into a market order, which can take you all the way down to the bottom. It's better to look at your portfolio once a month and to rotate into those asset classes that are strong based on momentum. those are the ones that are not going to crash. Before the S&P 500 crashes, it always loses momentum. So it'll never be in the top 3 when it's about to go into a dot-com crash or a financial crisis.
All right. And then I noticed, what you've been talking about, the different portfolios. The question was, what exactly is the difference between these portfolios?
The Baby Bear portfolio is a clone of Jack Bogle's 2-asset class portfolio that he's been promoting for 30 years. The Mama Bear portfolio is a muscular portfolio which selects from a menu of 9 index classes. And the Papa Bear portfolio uses a menu of 13 index funds that model the Ivy portfolio author Mebane Faber, who has written many papers that are available on the web showing why you want to check your portfolio once a month and you want to use asset rotation and not stick with a lazy portfolio.
All right. Let's see. We have, what are your criteria for entry into an asset?
We are choosing to hold 3 index funds at all times. We show in the book that you actually make more money with less risk when you have 3 index funds to diversify your portfolio rather than just buying the one that's the top rated. So there isn't really an entry rule. You can look at the website at muscularportfolios.com, and about 3 months out of 12 there will be no change from the ETFs that were rated the top 3 1 month ago. About 9 times out of every 12 months you will see that there has been some change. So you will sell the ETF that's dropped out of the top 3 and purchase the ETF that now is in the top 3. That entry rule, these trends are slow enough that you don't have to worry about, do I buy it on the first day of the month or the second day of the month? Just about anything works, because actually with the Papa Bear portfolio, the majority of trades are long-term capital gains. That's important for people who have money in taxable accounts. You're not jumping in and out of the market every day. You're rotating gradually, and more than 50% of the sales that you make, you held that ETF for more than 12 months.
All right. Let's see. I think that pretty much covers the ones I have. If I see any more, I'll get them to you. But here is the website. The book is here. And, with Chrome, I think some people were having a bit of an issue to get to the website. But if you just do just type in Muscular Portfolios.
There's no space.
You're going to get it right there. And
well, it's a good thing that we show up in Google on the top hit for our own name.
Yeah, that's always a good thing, right?
Very good. That's a very good thing.
So yeah, that's one way to get to it. I know on Chrome there were a little bit of issues, but that's the easy way to get there. And yeah, there's how you can get the newsletter, and it all looks great. Tom, did you have anything else?
Not really. I mean, I think the questions that came in were really good ones, and I think Brian did a good job of answering those.
We should mention the poll. We had that poll up, and actually the majority of people who replied to the poll said that Warren Buffett beat the S&P 500 during the last 2 bull markets. And as we saw in the presentation, Warren Buffett actually underperformed the S&P 500 in the last 2 bull markets. It's entirely because he keeps his losses small during bear markets that he is one of the world's greatest investors and with the best performance.
Excellent.
That's amazing. I don't know if I would have said, what were those choices? What was it was greater than 5% or more than 5 percentage points annualized, 0 to 5. I think I probably would have gone 0 to 5. I mean, he's not somebody who, goes out there with major risk, but I probably would have been with the 20%.
He is an absolutely phenomenal investor, truly a financial genius. And think of all of the articles, the thousands of articles written about Warren Buffett, and which ones of them told you that he underperforms the S&P 500 during bull markets? Almost none of them. We really need individual investors to understand this. It's not high risk, crash your money, risk taking that makes you a successful investor. It's keeping your losses small and knowing how to use diversification and momentum that makes your portfolio soar.
Yeah, I think technically too, at least from, obviously I've got a lot at stake in terms of the technical side of things and taking a look at price action. But the market does give you clues. I listened to one of your comments earlier saying that the market just doesn't fall off a cliff. I mean, it goes through a period of rotation. It does tend to waffle a little bit before it starts making the big drops. And I do think part of technical analysis is trying to be objective and recognizing that before you start to get those big drops and preparing yourself for those drops, because then inevitably we will see them from time to time.
Yes, even in the Black Monday market crash of 1987, you were down 20% in the Dow in one day. That didn't happen in one day. It took 2.5 months. The S&P 500 lost its momentum. It started trending sideways, and people who are following a momentum portfolio like Muscular portfolios would have rotated out into other types of equities like emerging markets, other type of fixed income investments like bonds and real estate, which did not crash in 1987.
Yeah, and you also want to be careful if I take a vacation and I don't have internet access, because I have there's a very strong correlation with the market going down and me not being able to get access to the computer.
That's actually one great thing about Jack Bogle's portfolio, the 2-asset portfolio. If you're going to sail around the world in a sailboat, you're not going to have very good internet access for months at a time. You can put your money into Jack Bogle's 2-asset class model, and 12 months later, you're very likely to have more money.
That's good to know.
Yes.
I know in 1987, of course, computers, they were there, but, wasn't like it is today. And I was on my honeymoon during that crash in 1987.
Wow.
Yeah, so when I got back, I'm surprised my marriage survived.
That's good. That's good. And we're trying to teach people how to gradually rotate their portfolios, not make big changes. My wife's parents were 100% in the S&P 500, and they sold all of their equities the day after Black Monday, and they were down 20, 30%. They are doing what a lot of people do. They're following their opinions. They're thinking, what should I do? I'll do this, I'll do that, instead of having a very gradual, very simple asset rotation method.
Absolutely. Well, it certainly was great having you on here, Brian. Again, go to www.muscularportfolios.com. Check out the website, and hopefully we'll get you back on here soon, Brian.
Great, Tom and Aaron. It's been fantastic talking with you.
Excellent. As with you.
Yep. Enjoy your weather in Seattle. I think
are.
you're going to enjoy it a little more than I'm going to enjoy mine the next couple of days.
You can have our rain.
Oh, I think I got your rain. I think I got everyone's rain.
I think so for the next 5 years.
Exactly. But okay, appreciate it. Thanks, Brian. And we'll have you back soon.
You're welcome.
All right, let's get started on that 10 and 10 for sure. I got lots of requests here. I have closed them out. I'll get to the RRG right now. And there you go. I thought I would just quickly run through. If you select one, and then if you're on a Mac and you hold the Shift key down, we can look at each one. Canopy growth definitely looks interesting, moving in that northeast direction. EGHT, let's see. Let me go through. I'm not sure why it's not quite. There we go. HCLP. And AT&T. Yeah, it looks like it's not working. I think it's just a matter of, there we go. There's a few. There we are. So I'm going to be looking for those ones that are moving in the northeast direction, but also I like to pay attention to what sectors we have. And today, I mean, we did have quite a few requests, not as many as normal. I think everybody was paying very close attention to Brian, which I think is great. But healthcare seems to be the winner as far as what people are interested in seeing right now. So I'm going to give it back to you. Our first one is PetX.
Okay, this is a biotech stock, and it's a fairly small one. It's only a $5 stock, so just understand that the volatility can be pretty significant in stocks like this. But looking technically at the chart, clearly we were in a downtrend for quite some time. Look at the volume coming at the end of March, early April, though, as it began to change its character here. We struggled after topping in May, came back one more time, but held above those prior lows, and now we're trying to take out this high. So I think the overall trend lower that we had to begin 2018 is trying to reverse, but I think we need to get through about 555, 560 and get some volume in. Volume trends have been pretty strong, but again, you are talking about a solo biotech company here which can be extremely risky. And, one piece of bad news, and you can see, quite a bit of a chunk taken out of the stock price. So it's the type of stock that if I was going to get in, I'd keep a fairly small position in because I don't want something like this to ruin a portfolio. But technically, I do like the fact that it's been trying to hold this 20-day moving average. And if we could get through 560 and get a little volume coming in, I think this is one that could make a run, at least initially, up for that $6 level.
All right, excellent. The most popular in the chat room by a mile is AT&T. T, of course, for the symbol.
Yeah, AT&T is trying to make a break, and this is an area where it's going to become pretty important. It's been downtrending for a while. I've not really bought into some of its moves in the past. This one is starting to look better, in my opinion, because we have put in, at least today, we're trying to put in a higher high. We already have a higher low. And so I think over the intermediate term, you can see that this reaction high coming off the huge gap down earlier is going to provide some overhead resistance. It already is. And then finally, where we gap down from is going to provide some sellers as well. So the big gap down on the volume, and you can see volume trends here, much different than what I just looked at on that small biotech company. Here, most of the days to the downside have been gaps, and they've been accompanied by very heavy volume, whereas moves back to the upside have been much less, although today's volume is beginning to pick up. So there are some mixed signals here. If you look back over the last year, AT&T has not been one of the best performers. I think it's got to prove something to me before I would be jumping in. The two key areas, though, to watch, 33.50, which was about the high in the second week of June, and then trying to get through the top of this gap resistance around 34.25. So we've made a huge move so far in September. That's great. I still think there's work to do here on the chart, though.
All right. The next one I have for you is LITE. Apparently, it's down $12 in the last 5 days. Wondering if it's hit a bottom.
Well, another one that's been going sideways for a while, and it's just in a wide range. Volume trends kind of, so-so. Another one that's got a couple of big red volume bars to go with these down moves. I'm not really seeing anything. I'm going to pull up a weekly chart, maybe see if the longer term chart maybe gives us a better sense of direction. And actually, I think it does. I think you got an uptrend. We've been consolidating for quite some time. So I think based on this, I would annotate and be expecting eventually a breakout. But we've got overhead resistance up just above 70. And you could almost draw an ascending triangle here. Typically, you shouldn't draw the ascending triangle from here because you don't have the high in place yet. So I'm not going to start there. Really, it would be from here. So that would be, because this is point A, you've got to get to a high before you can have a continuation pattern start to develop. This would be B. This would be C. We're coming back down. I think we might have a shot at about 55 on this pullback. So I think we're in a trading range, maybe 55 to 70. But ultimately, longer term, I think this looks a lot better than it did on that 1 year chart that I was showing, because all it was showing was the consolidation. But we do have a prior uptrend in play. So I would say that I'm a little bit bullish on this one, but it may just take some time to go through this consolidation phase.
All right. How about Constellation Brands? It was our only consumer staple request.
And that is
STZ.
Oh, STZ. I don't know why I was trying to use C there.
Stars.
Yeah, we've got negative divergence. That was a problem on a longer term chart. And I don't use these weekly charts very often, but I think it's a good example here. It really started on all of these highs back here as we kept going higher. We never did take out that prior high in terms of the PPO. So as prices kept going up, doesn't guarantee you're going to move lower. And you can see that we kept going higher for months before we ran into any price issues. But what the negative divergence tells me is that there's just higher risk in a stock. Again, not that it can't go higher, it's just that it's higher risk. And now you can see as we continued moving lower here, and well, the prices moved higher, you can see that the PPO just continued rolling over. And now we are trying to get back up through that 20-week moving average, which is crossed below the 50-week moving average. So there are some things to watch here. I would be maybe taking a look at this 220 area as key resistance. And I would not be surprised to see STX or STZ fail and maybe make another run back down toward the 200 level. So this isn't one of my favorites. We had a big run, negative divergence, sideways consolidation, but we actually did just print lower lows. And so that's starting to make me think that this is a down sloping head and shoulder pattern, left shoulder, neckline, head, right side of the neckline, which is down sloping, and a right shoulder. Be careful if this breaks down below about 198, especially if the volume picks up.
Okay, next one I have is Yelp. Kind of an interesting formation to me. It looks like a descending triangle, gap getting ready to be filled to the downside. I don't know.
I really like it. This fits my strategy to a T. Yelp is on my strong earnings chart list. And I love when a stock gaps up like this on massive volume and just keeps going higher. Stock was 38. 2 days later was 51 and change. It needed consolidation. We're getting it. The two key areas of support to me are at about 43 and a quarter and 44. Today's low was down near that 44 level. I just like it from a reward to risk. Not that it's guaranteed to go higher from here, but you can keep a fairly tight stop to the downside with a target up over 51. So I like it.
All right, excellent. Let's see the next one. Let's see how many puns we'll get out of this one. I don't know. CGC, Canopy Growth.
We used them all last week. I'm not going to go. Great volume trends. Certainly an uptrend in play. I don't think anyone will question that. But let's take a look at the actual trend. So here you got the trend. And on the most recent highs here, the last two highs, I'm seeing the PPO continuing to go higher, which tells me that we've still got solid momentum in the stock, even though we are maybe topping in the near term. As volume shrinks, and that's what we've been seeing here the last couple of trading days, I think we could see a pullback to that rising 20-day moving average. And that's where I would feel a little bit better about a short-term bounce. So I'd be watching that 20-day. Also, the support level comes in just below this level. Now, this stock has gone from, 25 to 55 in a couple of weeks. So you've got to be willing to accept higher risk on a stock like this, or you shouldn't trade it. But I think 42.5 to 45 is kind of an accumulation zone for me. If you close much below 42.5, I'd be really careful. And then a move back up to that 55, 56 area is what I'd look for.
All right. The next one I'd say is an interesting chart. Dow DuPont, DWDP. It's, doesn't fit my mode because of my PMO, but I do kind of like the setup here.
All right. Dow DuPont. Well, first of all, it's in the material space, which is the lowest scooter of all the ETFs. So you got to understand you're trading a group that has not been particularly strong. And it, on a relative basis, this has not been a great performer. So it probably would be out of my realm just because of that. Mm-hmm. But I would be looking maybe at this trend line that has been holding. We have many, many tests of the trend line. So I don't want to see that fail. And that would be down around 67. The last pullback was 67 and change. So I'd probably keep a fairly tight stop if I was in it. I just think there are a lot of other candidates out there that I like better just because I want to be in areas that are outperforming the market, and the materials group, for the most part, is not one of those areas.
All right. This next one I definitely like. ARC Best Corp, ARCB. It broke out above resistance and it pulled back, which is what I like to see. And the PMO is slowly rising after a buy signal. So I don't know about you, but I like it.
Yeah, I like it. I would have liked it a little more if we'd seen more volume coming in on this breakout after consolidating for 2 months. You'd think that as we break to new highs, that it would attract a lot more buyers. And really, the volume is a little, sketchy. Mm-hmm. So if we fail to hold the breakout and maybe be careful, we might see a little bit more consolidation. I think it's possible we could see maybe that 50-day test come in, or maybe these recent lows in 47. But overall, I agree. I think this is a nice-looking stock. Made a huge run, 32 to 50 in about 2 weeks. It needs consolidation. It's earned some consolidation. So I would just be careful if it fails to hold the breakout level here. then maybe we see more consolidation. It just gets frustrating. But ultimately, I do see this one going higher.
All right. Autodesk, ADSK. Interesting chart. It doesn't fit my investing strategy, but I think it's interesting for sure.
Yeah, it went sideways for a while, broke out. I think the 20-day could hold. If it doesn't, I would actually I would accumulate it between the 20-day moving average and the price breakout level, which now becomes price support. So that would be right in about that area. So after the initial move higher, you can see the massive volume that came with the stock on this push to the upside. But we did fail to hold that support level, led to a 20-day test or near 20-day test. I would actually be buyer between 142 and 147, and maybe the stop is down below the gap support around 136. That would be roughly about 5 or 6% downside risk. But I think this is a really nice looking stock. Eventually, I see a move back up to 160 and eventually a break above that level.
Okay, and our last one for our Canadian friends. Canadian Western Bank, CWB.TO.
Okay, well, we are at another key support level. The volume has been big on the recent selling, but in my opinion, we haven't lost any major support. So I would be looking right down in this zone. So we broke out right here on very heavy volume, the heaviest volume of 2018. Huge gap up. I love that candlestick. That just shows a lot of accumulation. Notice we came back down, tested that area, and then in 6 weeks, we're right back near the top of it again, broke out. This is one of those examples I would like to have seen more volume on this breakout. We ended up coming back down on heavy volume, but now we are in a key support area. I think 34.50 to 35 is a good entry point. I'd have a closing stop below 34. That's my gap support area. If you wanted to give it a little more room, you could go down to maybe that 33.5 area, but I'd keep it fairly tight. My target would be up closer to 39. So I like the reward to risk here in CWB.TO.
All right, excellent. Just a reminder, here are the symbols that we went through. You will find those in the Market Watchers live chart list. Just go to our homepage, click on the blogs tab, and once you find our Market Watchers live blog or recaps, you will find the link right in there. And I did want to let everybody know that Brian is in the chat room, so he is available to take some of the questions that maybe I didn't get to when he finished his presentation. All right, time for our final market update. Let's go ahead and get to it. Interesting markets going on right now, I must say. All right. At this point, what I find the most interesting is industrials are certainly having a good day with the Dow up right now, just above 93 points. The S&P 500, however, while it is up, has spent some time in negative territory, might be able to recapture some gains, but right now almost unchanged, up 11.11 at this point. NASDAQ is lower and has been trading in negative territory all day. We have what could be considered sort of a double bottom here. I would look for it to move higher and test these intraday highs, but certainly technology struggling, and the S&P 100, similar to the S&P 500, only up slightly, mostly unchanged, really. S&P 400 and small caps suffering today along with the NASDAQ. And the Canadian markets, TSX, is also trading in negative territory, although it has recaptured some of those losses. So we're not looking at as deep a decline as we had this morning. Treasury yields are down somewhat, currently reading 2.957%. UUP, we can see, is trading lower. It has found an area, it looks like, of some support at an intraday low right around 25.12. But it is still in decline, could be forming a reverse flag, which of course is a bearish pattern and could mean more downside action. Not a surprise, given the dollar's demise right now, that gold would be moving higher. Currently, GLD is reading just above 114 and 7 cents. TLT, big gap up, but is moving mostly sideways here, was unable to get above yesterday's gap down on the open. So that's holding as overhead resistance, although TLT is up 44 cents. USO is higher right now, reading at 14.89. And that's all I have for our final market update. Tom, did you have a chart to share while I get my spotlight stocks ready?
Sure. Twitter is the worst performing stock today in the S&P 500. And I just wanted to pull this chart up and take a look at a couple of other the internet stocks as well. But Twitter, you can see, is broken back down below that the big drop off that we saw late in July with its earnings report. So it is trading now at new lows. Take a look. Internets, I've talked about that. We've got a head and shoulder breakdown in the group. And when you look at Twitter, you can see on a relative basis now for the past 3 months, we are really struggling. So Twitter is underperforming a very, very weak group of peers, and that's not good. As you can see, it's underperforming the S&P, and here is the internet group relative to the S&P 500 near a one-year low. A couple of others in the same space, just to give you an idea. I know we talked a little bit earlier about Snap and how weak that was and the downgrade that it got today. Take a look at the relative strength of Snap relative to the internet stocks. So again, we've got a weak group, but here you've got one of the weakest stocks in the group. And then finally, Facebook, which I'm not a big fan of. Again, I think this one goes lower. I would not be surprised at all to see a 150 test of that March-April low. And when you look at the relative strength of Facebook versus the internet group, you can see that outside of a couple of months prior to earnings on some fairly light volume, we've got Facebook, which has been downtrending relative to the internets for quite some time. I expect that to continue. And this is one of the reasons why we talk so much about relative strength, because if you've got a group that's underperforming and then you've got stocks within that group underperforming, their chart is likely to go only one direction, and that's lower. So I'd be careful with many of these internet stocks.
All right. Excellent advice. Okay, I guess it's time to get into spotlight stocks. And again, this segment, what we do is try to find some stocks that are interesting that you should look at based on, they could be breaking out of a base. They could have just really unusually high volume, or some other technical reason. I am going to share a few that I found traipsing around the market. And I'm going to start with, let's get that one there, KKR and Company. I had some scans that I ran, but mainly I was looking at a lot of different things. The high volume, I was looking at, PMO setup, etc. But a lot of them, I was looking for good chart patterns or breakouts that we have seen lately. And KKR, I think, fit that bill. I see the double bottom. We haven't executed it yet, but we've already broken out of some longer term overhead resistance. That declining trend is already broken. And of course, the steep one was broken earlier on Monday. So I like this setup. I've got a PMO ready to have a buy signal, and look at the volume coming in. I think that makes for a very interesting trade. The next one I wanted to show you is Nike. Of course, they've been in the news quite a bit lately. They are experiencing a bit of a pullback right now, but the PMO has turned around, and we did see a breakout. Let me get the annotation tool here. We did see a breakout yesterday. Just a slight one right there. You can see that it did move up above that overhead resistance. It is pulling back right now, but it's getting close to that 20-day EMA. This could be a pretty decent setup. I'd be watching that PMO though. As you can see, it's starting to flatten out. It was actually rising this morning when I first picked out Nike. Next one I have, Infosys Technologies, INFY. I think this one's quite interesting. We have this rounded bottom, and today we're getting that breakout. And look at that really nice PMO scooping upward. I suspect we're going to see a buy signal here soon. Really nice setup here with that breakout just now occurring. It is up a little over 1% today, so we might see a little bit of a pullback tomorrow, but I think this one could continue to run to the upside after that breakout. Next one, Jacobs Engineering Group, JEC. And this one broke out just recently from overhead resistance and what I would consider an ascending triangle. These are bullish patterns. The expectation should be, and let's go ahead and annotate this so you can see it. Here we go. So there's the rising bottoms line, and then here's the overhead resistance at those tops. So that's your ascending triangle. And then what you want to do, let's use this tool just for fun here, is you want to measure the height of this pattern from the back end. So I'm going to start with this low and I'm going to move it up. And this is the size you should expect to the upside. So you can even just drag one of these up, and then you can get an idea generally of how high you're looking at going. In this case, you're looking at a $4 move as a possibility, or just under. So you could see move up into the 78 area. And look at that PMO curling upward on a rising bottoms trend going on here. So really liking the Jacobs Engineering Group. I think this one is starting to really turn here as it's broken out from that ascending triangle. Right here, you can see that we now have a breakout coming in on pretty decent volume for the Barclays short-term high-yield bond ETF. So I thought that one was interesting. You've got a PMO that is now hooking upward, and you have a positive, or I should say a reverse divergence, with rising bottoms on price and declining bottoms on the PMO. You know, it may not seem intuitive that you would want to see these momentum bottoms moving lower when you're seeing the price bottoms moving higher. But to me, what we see it telling us is that we've been able to unwind and get out of that overbought territory with really without too much deterioration in price. So I like this breakout right now. It's only a 0.15% breakout, so we don't really need to wait too long for a pullback here. But watch that gap, because we could see this be an island and then, you know, get that opening down to the downside. But I think this is set up pretty nicely. We've had a lot of interesting things going on in the telecom or the mobile services. And you know, right now there's been talk of, I believe it's T-Mobile and Sprint getting together to form, I guess it would make a big three as far as the mobile devices and services, I should say. Look at this breakout move, and I'm sure it has to do with rumor on this possible merger between the two. But honestly, you know, it was forming this really interesting trading channel. And, you know, had we gotten a breakout even without, you know, some news, if you want to say, going on, I would be very pleased with this. You've got a possible intermediate term flag here. If you go to the weekly chart, I'm sure we can see that forming up here. And now we're getting the breakout for that flag, and you measure that flagpole, and we're looking at a move of, you know, probably $8 to the upside if you did the measurements here for that flag. So I think that one looks really interesting. So I decided to look at Verizon and Sprint, but let's go ahead and look at Sprint, which is part of this move. And you can see a similar situation, a long time of consolidation, and now we're getting that pop to the upside. The PMO is not overbought. It's bottoming. It's confirming price rising, the price rise here with the bottoms rising as well. So I like Sprint. I think that one looks very interesting. And then finally, I took a look at Verizon. And we're seeing a similar pop to the upside and a breakout. Now with Verizon, you can see we were more in a decline, but we have made quite a move in momentum on this rally to cover up that initial gap on the high volume selling. So now we have a little bit of a hook here on the PMO moving higher, and we have a breakout. Hasn't closed above it, as you can see with the thumbnail, but real interesting. So let me pass it back to you, Tom. What kind of spotlight stocks did you have?
All right, I wanted to move more into the semiconductors again because they have been hit so hard. And I wanted to start with a couple of companies. First, Applied Materials. This one has been moving down. I mean, this was one of the hottest stocks in the market when we went back to March. It was breaking out, it was up near $62. Now the stock's down near 38, just doesn't seem to have a floor. Volume has been picking up. But what was interesting is as it was making the highs back in March, you can see that the semiconductor group was also breaking out. But on a relative basis, Applied Materials actually topped all the way back in October of 2017. So all the way back here, even though we saw more absolute highs, the stock was not going up as fast as the rest of the group. So when you start failing to hold breakout levels, I mean, you can see a couple of months later here from March to June, the group went to a new high, but look at what Applied Materials was doing. So there have been a lot of warning signs on Applied Materials in many of these semiconductor stocks that you were going to be in for some action to the downside. Now, when I looked at my strong earnings chart list, and by the way, those who asked for it, I am still in the process of sending that chart list out. Just have some patience. I'll try to get that out as quickly as possible. But when you look at the list of semis that are on this list, there are only a couple of these that have scooters down around, down below, say, 50. And there are 3 of them that are still very strong stocks. And I'm going to take a look at those in a minute. But just goes to show you that beating top and bottom line and continuing to trade well on the charts does matter when it comes to future performance. And so let's take a look at some of these stocks. So Applied Materials was the first one. I think also Micron certainly on this list. Let's take a look here. Same kind of a deal with Micron. We did top with the overall market back in, what was that, late May, early June. But look at Micron since then on a relative basis. It is falling off a cliff. The overall group has been holding on to support, but Micron has not. Micron completely has fallen apart. So when you start breaking down below price support and you also have a relative underperformer, that's when you want to be really careful. LRCX, and many of these semiconductors, by the way, are in the semiconductor equipment manufacturing space. That seems to be where a lot of this weakness is right now. Lam Research just broke down. See the volume picking up on this breakdown going across here. Again, relative strength, horrible. You look at NXPI. This was one that broke down in a big way earlier today, trying maybe to short-term bottom, but the overall trend has been horrible. Any kind of a bounce is likely to be very short-lived. SWKS, these are all stocks, by the way, that I would avoid in the semiconductor space for now. You've got Skyworks breaking down below its April low. And once again, you can see on a relative strength basis, you really want to try to avoid stocks that are not performing well within their group of peers. ASML, which is ASML Holding, multiple support area around this 188, 190 level. Once that broke, we've seen about a $20 drop in ASML. And of course, on a relative basis, we have now seen the stock drop to a 52-week low versus its peers. Intel, one of the most recognizable names in the chip space, but kind of like Applied Materials. It actually topped later than Applied Materials, but you can see same kind of pattern. We just keep drifting lower and lower, and on a relative basis, not good. QRVO, and this is Corvo, another one that's broken down recently. We'd had a triple top going across here. Really needed to hold on support. When it didn't, we saw the volume pick up, more and more sellers. I think it's probably heading down to test these lows that we saw back at the end of 2017 and early 2018. Then we've got Microchip. Microchip, another one in this long line of underperforming semis. I mean, I could just almost just put a cover over the name. They all look the same to me, or very similar. STA Microelectronics, sideways action for a long time. Look at the gap down here. Volume trends have been picking up. Again, another stock under pressure. On Semiconductor, ON, another one. Not quite a double top, but certainly breaking down below prior support levels, continuing to pick up. Volume trends turned more negative, and look at that relative performance. These are stocks you want to avoid. Now, Within the semis, there are stocks that are performing well. So if I was going to trade semis, the stocks I would be looking at would continue to be some of the winners. AMD has been on fire. I agree with those of you maybe waiting for a pullback and we just don't seem to get one. That would be the only concern for me with AMD. I think we're going to see another blowout quarter when AMD reports in another month or so. IDTI, this is a smaller semiconductor. They also beat their earnings expectations recently, and you can see the reaction here. And then finally, SMTC, which is Semtech. This one is on, actually, these last three have all been on my earnings, strong earnings chart list. But here, huge move up. Check out the volume. You can see after moving higher, sideways consolidation, rectangular consolidation. That's a nice continuation pattern. We broke out. I see it going higher. Probably we'll get this one on a pullback, maybe to the 20-day moving average, maybe even down around that 53 level. But SMTC is among a few that I think look pretty good. So let's take a look at the summary of the stocks that we just covered in the Spotlight stocks. I know, Aaron, you had a smorgasbord, a lot of different areas. I kind of focused just on some of these semiconductors that for the most part are getting absolutely crushed here over the past 3 months.
Indeed. You always have such a plethora of stock symbols. Yeah. I'm amazed at how quickly you can go through them, and I need to practice, I guess.
Well, they weren't, I mean, once you saw one, the first 12, once you saw the first one, the next 11 looked pretty similar. So it wasn't too difficult to go through them. I just wanted to point out how much weakness we are seeing in semiconductors. And then you throw in what's going on with the internet stocks, and you got to wonder, if market may be getting a little bit toppy here in the near term.
Yes. You don't want to see an aggressive sector like technology suffering to the degree it is. And, with that last market update, I mean, you saw the NASDAQ is lower along with the S&P 400 small caps, yet you see the Dow and the S&P 100 and 500 in positive territory. So definitely something going on there in this, what I guess we can call a bifurcated market right now.
Yeah, it is certainly bifurcated. I mean, even if you look at just the sectors today, I mean, you've got consumer staples, which is up more than 1%, energy up close to 1%, industrial's not doing badly. And then you look at the bottom of the rung, and you've got financials down almost 1%, down 0.83%, and technology only down 1/3 of 1%. But if you look down to the bottom, the two groups I was just talking about, internet down 1.7% today, semiconductors chasing them closely, down 1.69%. Those are two areas you got to be really careful, especially if semiconductors fail to hold that recent low. That's what I'm going to be watching pretty closely this afternoon.
Wow, what a great show. We had a great guest today. I know the rest of the week, it looks like it's going to be pretty exciting. I can show you that schedule right here. I'm particularly excited to talk to Mary Ellen again. We do both live in the LA area, and we do try and get together, but it'll be nice to talk to her. I can't wait.
Yeah, and it definitely was a pleasure to have Brian Livingston on today. I want to thank him again for that. And of course, talking about the issues that we might have. I'm looking past the market. Of course, Hurricane Florence. That's going to be quite an issue here over the next couple of days here on the Carolina coast. But again, I want to thank everybody for being with us today. We always appreciate you being with us. Please remember to complete the survey as you exit. We'd love to get your feedback. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.
Here's how to put a simple line on your chart without using the annotation tool. Let's say we want a line in here at 47.50. You can just drop down here into the overlays, pick horizontal line, add the price point, 47.5, and we're going to use a red line. We're going to make it solid and thick and hit update, and that blasts it into the middle of your chart.